Today, we're embarking on a deep dive. We're cutting through the financial statements to really get at the story behind Relaxo Footwears Ltd, India's largest footwear manufacturer.
That's right.
You've given us their unaudited Q1 FY26 results, the investor presentation, the board meeting outcome. So our mission here is to pull out the key insights, maybe find some surprising facts, and help you understand what it all means for Relaxo and, the wider footwear market in India.
Yeah, and what's really fascinating, I think, is seeing how a company like Relaxo, a big player, navigates what's clearly a challenging market right now. So we'll be looking beyond just the headline revenue and profit. We'll dig into the strategy, the decisions they made, and how their fundamental strengths might set them up for the future, especially given the dynamics in the Indian footwear scene.
Okay, let's jump straight in then. The numbers. On July 30, 2025, Relaxo declared its Q1 FY26 results. This is for the quarter ending June 30th, 2025. So what are the headline figures we need to know right away?
Well, the top line, revenue for Q1 FY26, it stood at 654 crores.
Right.
Now, what's important to note right off the bat is that this was actually a decline. It's down 12.5% compared to the same quarter last year, Q1 FY25, when they did Rs 748 crores.
Wow, 12.5%.
Yeah, and it was also down compared to the previous quarter, Q4 FY25, by about 5.8%. So a dip both year on year and quarter on quarter.
So revenue down, that sounds like a pretty tough quarter on the surface. But here's where it gets really interesting, doesn't it? Their profit after tax, the PAT, it actually went up. How does that work?
Exactly, and this really brings up that classic question, profitability versus just pure sales volume. So while revenue decreased, yes, their profit after tax for Q1 FY26 was Rs 49 crores,
Okay.
and that's up 10.2% year on year. It was Rs 44 crores in Q1 of FY25.
So how did they pull that off? Margins?
Precisely. The key is in the margins. Their EBITDA margin, it expanded significantly,
Yeah.
but by 198 basis points, or nearly 2 full percentage points, up to 15.2% from 30.2% last year.
That's quite a jump.
It is. And the POT margin also saw a big improvement, hitting 7.5% compared to 5.9% in the same period last year. So it clearly points to a really strong focus on efficiency.
So fewer shoes sold effectively, but making more money on each pair. What about the actual volume, the number of pairs?
You've got it. The number of pairs sold in Q1 FY26 was 4.3 crore. That's down from 5.0 crore pairs in Q1 FY25.
Okay, so a noticeable drop in volume.
Yes, but interestingly, their average realization per pair went up slightly. It was Rs 151 in Q1 FY26 compared to Rs 150 in Q1 FY25.
Ah, okay.
So that suggests maybe a healthier product mix, perhaps selling more of their higher value items, or maybe some effective pricing adjustments. And you see this reflected in the earnings per share, the EPS too. That grew by just over 10% to Rs 1.96 from Rs 1.78.
Right. Now, the press release itself, it doesn't shy away from the reasons for that revenue dip. What did management say were the core challenges this quarter?
Yeah, Mr. Ramesh Kumar Dua, the chairman and MD, he was quite direct, called it a challenging quarter.
Wow.
He specifically mentioned continued muted consumer sentiment. And importantly, he said this was particularly affecting the mass and mid-market segments.
So the everyday buyer was holding back a bit.
It suggests that, yeah, discretionary spending, like on footwear, especially at those maybe more accessible price points, was constrained. People were likely being more cautious with their money.
And it wasn't just consumer sentiment, was it? They also flagged increased competition.
That's right. He specifically mentioned intense regional competition in the general distribution channel.
Yeah.
Basically, more heat from smaller local players.
Okay.
And what's really fascinating, I thought, was that he directly linked this rise in regional competition to the GST increase, the one back in 2022, that took footwear from 5% to 12%.
Ah, that's an interesting connection. So the idea is that higher GST rate created an opening for smaller, maybe less formal competitors.
That seems to be the implication. Perhaps it made it harder for fully compliant players like Relaxo to compete on price alone against smaller outfits who might have, let's say, different operating structures or compliance levels.
So, faced with those pressures, cautious consumers, tougher competition, how did Relaxo react? It looks like they made a conscious choice, didn't they? Prioritizing the bottom line.
Absolutely. The management stated very clearly they consciously avoided short-term tactics such as deep discounting.
Which is bold, resisting the urge to just slash prices to move volume.
It is. They chose to protect profitability and, you could argue, their brand value. Instead of chasing volume with discounts, they focused inward.
On efficiency.
Exactly. Enhancing operational efficiencies, disciplined cost management, streamlining back-end processes.
Yeah.
And, well, the proof is in the pudding, right? Those improved operating margins we just talked
Yeah.
about. So it's a strategy that lays a foundation for the long term, even if the top-line growth takes a temporary hit. It's that classic balancing act.
Okay, so that's the quarter. But let's zoom out a bit. This deep dive isn't just about 3 months. What are Relaxo's underlying strengths? What allows them to navigate these rough patches?
Yeah, good point. Connecting this to the bigger picture, Relaxo really does have some robust strengths, operationally, strategically. First off, their distribution network is vast.
How vast are we talking?
We're talking approximately 70,000 plus multi-brand outlets, plus around 550 active distributors across India, and 406 of their own exclusive brand stores.
That's huge reach.
It is. And they're not just domestic. They export to about 36 countries, even have an office in Dubai. So there's an international angle, too.
And their manufacturing base. That always struck me as a key advantage.
Oh, absolutely. It's significant. They have 9 manufacturing facilities. And get this, the total capacity is around 10.5 lakh pairs per day.
1.05 million pairs a day.
Per day, yeah. And they really emphasize continuous optimization there, dedicated lines for popular items. Lean manufacturing, cost control. Having that strong in-house manufacturing is critical, for controlling quality end to end.
Right, from design to the finished shoe.
Exactly. And they back it up with various certifications like ISO standards. It signals a real commitment to quality and process.
What about the products themselves? How diverse is their portfolio?
It's quite diverse, built around strong brands. You'd recognize Hawaii, Flight, Skarks.
Right.
And there's an interesting dynamic if you look at the FY25 mix. By revenue, Sparks was the biggest contributor at 40%, Flight was 37%, and Hawaii 23%.
Okay, so Sparks brings in the most money.
Yes, but look at the volume. Hawaii actually made up 45% of the pairs sold, Flight was 39%, Sparks is only 16% of the volume.
Ah, so Sparks sells fewer pairs, but at a much higher price point.
Exactly. Sparks clearly commands a higher average selling price. It's positioned more towards the, let's say, premium or performance end within their portfolio compared to the mass market Hawaii. And that higher realization from Sparks definitely helps their overall profitability.
Makes sense. And financially, how healthy are they? What's the balance sheet tell us about their resilience?
Well, this is another real strength. Their financial resilience looks pretty solid. They have strong credit ratings, ICRA for long-term, A1 plus for short-term.
That's investment grade.
Yes. And what's really quite impressive is their net debt position. It's actually negative. They are net cash positive.
Meaning they have more cash than debt.
Significantly more. Their net cash position grew to minus 292 crore rupees in FY25. They reported 0 borrowings under current liabilities that year.
0 short-term debt.
Right. And their cash generated from operations jumped up to 464 crores in FY25. Plus, their current ratio improved to 2.7.
Which means plenty of liquid assets to cover short-term obligations. Very healthy.
Very healthy indeed. It gives them a lot of flexibility and stability to weather, well, challenging quarters like this one.
Okay, so Relaxo seems fundamentally strong, but how does this all fit into the bigger picture, the Indian footwear industry itself? Is the tide rising overall? What are the key trends?
Well, the Indian footwear market itself looks pretty attractive long-term. The projections show it growing much faster than the wider Asia-Pacific market, and indeed the global market.
Really? How much growth are we talking?
Estimates suggest it could expand from around $19 billion in 2024 to potentially $46 billion by 2033. That's a huge domestic growth opportunity.
That is significant. And within that growth, is there that often talked about shift from unorganized to organized players? Is that actually happening?
It seems so. The organized segment is expected to outgrow the overall industry. Its share is projected to increase from about 35% in 2024 to maybe 45% by 2034.
And that should benefit established players like Relaxo.
Absolutely. That's a crucial tailwind for them. Other trends playing out include, the growing demand for sports shoes, driven by health and wellness focus. There's the digital transformation, online shopping, personalization using AI, millennial preferences focusing more on personal style, and importantly, a growing consumer desire for sustainable and eco-friendly products.
So how is Relaxo positioned to tap into those specific trends? We talked about their manufacturing strengths, but what about sustainability or digital?
It's a good question. While the Q1 report didn't detail, say, specific new digital investments, their investor presentation does highlight things like product innovation and understanding evolving macroeconomic industry growth drivers as strengths. That suggests they are tuned into these shifts.
Okay.
And on sustainability, they explicitly talk about being a good corporate citizen, They list various ESG initiatives, projects in education, environmental stuff like water conservation, plantation drives, and health initiatives too.
Like the Blindness Project.
Exactly, the Nigh Unavoidable Blindness Project. So
Yeah.
they're clearly making efforts in that ESG space, which aligns well with that growing consumer demand for more responsible brands.
Right. Okay, so let's bring it back to the investor perspective. Looking at these Q1 numbers, their strategy, their strengths, what's the overall picture for Relaxo?
Well, if you look at the full year, FY25, there was a slight dip in revenue and profit compared to FY24. But these Q1 FY26 results, they show that clear strategic pivot we discussed, protecting profit, even if sales volume is down for now.
Resilient.
Yeah, their strong cash generation, being net cash positive, the diverse portfolio, that huge distribution network, it all points to financial resilience. And the shareholding patterns is interesting too. Promoters hold a very high stake, 71.27%.
Which usually signals long-term commitment.
Often, yes. Foreign portfolio investors hold nearly 16%, and mutual funds almost 10% as of June 30th. So, significant institutional interest too.
And what's the management's tone about the future? Given they're prioritizing sustainable, profitable growth, are they signaling confidence that the top line will recover?
The commentary from Mr. Dua certainly sounds confident. He actually said, "The groundwork we are laying today gives us confidence in delivering stronger results in the quarters to come."
Okay, so they believe the efficiencies and network strength will pay off.
It implies a belief that, yes, as maybe consumer sentiment improves or stabilizes, their stronger operational base will allow them to capture growth profitably. The focus seems very much on building a robust long-term business, not just chasing quarterly revenue figures at any cost.
So wrapping up this deep dive on Relaxo's Q1 FY26, it's really shown us a company playing a full game in a tricky market, hasn't it? Focusing hard on profitability, shoring up those foundations. We saw revenue dip, but strategically, margins and profits went up.
Yeah, what really stands out, I think, is that tension, the tension between the immediate market headwinds, the cautious consumers, the regional competition, and the strategic groundwork they're laying focused on efficiency and brand strength.
Right.
And it leads to, well, a thought-provoking question, doesn't it? Given their clear emphasis on operational efficiency, their reluctance to discount heavily, and these big industry shifts towards organized players and digital, what specific innovative levers could Relaxo pull next? Beyond just efficiency gains, what could they do to really reignite significant top-line volume growth, but do it in a way that's still sustainably profitable in the quarters ahead?
Reigniting volume growth without sacrificing those hard-won margins. That's the challenge. Definitely something for you to ponder as you reflect on this deep dive into Relaxo's performance and where the footwear market might be heading.